Welcome to Taking Stock for the week ending 2nd of December 2022, where this week, myself, Tim Lincoln, and our head of research, Kien, Trinh, streamed you all things share market. Before we get started, Kien, just need to share with you that all of the information that we share with today is of a general nature, and we obviously haven't taken into account your personal situation or needs, and all of the data and performance figures that we also share as of an historical nature and therefore should not be relied upon as a guide for future performance. How are you, Kien?
Not bad, Tim. I can't believe the month of December is already here, and it looks like the markets had an early Santa rally.
Yeah, it feels a bit that way. Yeah, I can't believe the year's done and dusted also. But, you know, we enter into a really important time of year relative to our portfolios and management of our portfolios too. We can't become complacent, but more on that later. But it has been a really big week for the markets, hasn't it? With inflation and interest rates continuing to really drive the themes. But this time around, it's been a positive theme for the markets based on the current commentary, especially around volatility. And there's been a real moderation in global inflation data, which has lifted the hopes that interest rates rises may be approaching a peak. In fact, the US Fed Chairman Jerome Powell indicated that the pace of interest rates in the US will slow this month, with the growth stocks bulls champing at the bit on the back of that news, Kien.
Yes, Tim. Powell suggested that the effects of the rapid interest rate rise over the last few months have not really been fully felt. So it would be prudent to begin slowing the pace of interest rate rises. Similarly, here in Australia, the monthly consumer price index, or CPI, that's slowed, rising at an annual pace of 6.9% in October, and that's down from 7.3% last month and well below market expectations for a 7.6% increase. So the RBA now, they expected to hold their policy meeting next Tuesday, and they are expected to lift the cash rate by 0.25% to 3.1%. And many analysts now believe the cash rate could peak below 4% in May next year. So a slowdown in the pace of interest rates could potentially provide a boost for quality growth and income stocks. And over the year, these stocks have been under pressure, Tim, as investors move away from those quality growth stories because of those lofty valuations. Meanwhile, defensive income stocks such as REITs, utilities, they've been hit on concerns about rising debt costs and falling asset values.
Yeah, Kien, it certainly has been a really challenging environment over, at least the last 12 months for our star stocks. And but we've just got to continue to remind ourselves, don't we? The good times don't last forever, or the cycles aren't there forever in regard to investing in quality growth or quality income stocks. Sometimes the cycles go against us, and we have experienced that over the last 12 months or so. But investing is all about the long term and looking through these cycles. We must do that because it can take time for the market to move, and it's important that we block out the noise and realize the real value of quality stocks. And this is highlighted in the chart on the screen, which shows the year-to-year performance of star growth stocks versus the All Ordinaries Index. And as you can see, star growth stocks have outperformed the market in 25 of the last 28 years. So again, at this last year may represent opportunity. That implies a success rate of close to 90%. So we've just got to ride through those cycles. Meanwhile, income investors haven't done too badly either. Since inception, not only have our star income stocks provided investors with well above market average dividend yield, which is obviously their objective, but have also outperformed the market 9 times out of the last 11 years, with the last year also being a year of underperformance.
Yeah, that's right, Tim. It's so important, the long-term horizon for investing. But looking ahead, with moderation in inflation and also interest rate rises, we believe, as you mentioned, the underperformance of the quality growth and quality income stocks could represent excellent opportunities for investors. You've got earnings resiliency across most of our star stocks over the AGM season, and that's suggesting that companies with strong financial health, those with wide profit margins and solid cash flows, they've continued to withstand inflationary cost pressures. Growth stocks, for instance, like Lovisa, AUB Group, IDP Education, tech stocks like Altium and WiseTech, they've experienced large consensus earnings upgrades over the last 3 months, Tim. Meanwhile, income investors have benefited from earnings upgrades across the banks. And then we even saw some retailers and telcos doing quite well in this environment, like Premier Investments and Spark New Zealand.
Yeah, long-term opportunities everywhere, aren't there, Kien, with so many of these high-quality businesses being oversold in the last 12 months. But it's really important to always keep an eye on the underlying fundamentals, isn't it? Because they can change, and therefore the names you've just mentioned may not be there in 6 months' time. So really important we continue to roll with the fundamentals, similar to some of the stocks that we're about to talk about as well. But we can never become too complacent at the same time, Kien, with the risk of recession rising. Also means more companies will become bankrupt. Remember, in the last since the start of the pandemic with stimulus and everything, a lot of companies haven't been allowed to fail. They've been artificially propped up. So we continue to expect that rise in bankruptcies to continue. And corporate insolvency numbers on the back of those COVID levels continue to really become manufactured now into real terms. For the calendar year to date, we have seen 10 listed companies move into administration. That is, go bankrupt, where investors lose everything. Meanwhile, according to our research, about 1/4 of stocks in the All Ordinaries Index are classified as zombie companies. And they're the companies that are on life support system and virtually the walking dead and will need capital raisings to survive. And here's just a few of those names that have failed in the last 12 months, but there's also many more amongst the All Ordinaries that are also on the cusp of failure. And that's where Stock Doctor comes to its fore too, to really easily identify those businesses. Also moving into our star stock highlights for the week now, Kien. There's been pretty big announcements with some of our star stocks. Government software provider and star growth stock Objective Corp was sold down really heavily late last week after they released guidance for single-digit earnings growth for financial year 23. And that was well below market expectations, which was expecting double-digit growth.
Yes, Tim, the downgrade was driven by an increase in operating costs, and that's predominantly in wages as the company tries to invest heavily in staff. While the downgrade was quite a negative shock, it is important also to point out that Objective Corp, they expense their research and development costs up front. And that's unlike other listed peers who tend to amortize this expense over several years. And so by understating earnings in the short term, what that means is that the company should benefit from stronger earnings growth in the longer term. And this is the reason why Objective Corp has a history of strong earnings quality.
Yeah, I also know, Kien, the stock is lightly covered by only 3 consensus analysts, and they're the analysts outside of our business. They occupy seats in external research houses from Lincoln Indicators and the Stock Doctor team. So we should be careful about relying too much on consensus figures because it is thinly covered. While we appreciate Objective Corp's strong earnings quality, it's there. We also need to be mindful that the downgrades to consensus may mean the stock is at risk of not meeting our star stock criteria when it reports next in February, especially with return on equity expected to fall to 35% this year, which is more than 10% below what our threshold is for the results of the previous financial year. Our research team is especially senior analyst Jason Yin will be monitoring this really closely over the ensuing months. And we never like to see multiple downgrades, especially on those thinly covered stocks like Objective. And aside from analysing star stock announcements, the research team, headed by yourself, Kien, are also regularly meeting with industry experts and company management, CEOs, etc., to keep abreast of the changing operating conditions within especially our star stock companies. And this week, Ryan Lim, the covering analyst, had the opportunity to meet with borderline star growth stock and star income stock insurance broking firm AUB. So what was the outcome of that meeting, Kien?
Yes, Tim. For those that may not be familiar, AUB Group, they are an insurance broker, and revenue comes in the form of commissions generated by selling insurance policies. And the inflationary environment, that's helped boost their revenue with rising insurance premiums. In addition, you have synergies from the group's recent acquisition of UK insurance broker Tysers, and that's these synergies and also earnings, that's contributions that occurred earlier than expected. So collectively, what we've seen is that these factors have led to AUB's strong earnings revisions and also support its gross dividend yield of around 4.3%.
Okay, and seeing this stock, Kien, isn't in a mainstream really insurer. They're a large business, but they're not in the mainstream group of insurers. It's suitable for growth and income investors who want to take advantage of the rising premium environment, but also don't want to have the exposure to some of those larger insurers who carry the risks associated with higher claims and poor investment portfolio returns.
Yeah, that's right, Tim. Now, looking ahead, there are not many Star stock announcements next week, but we will be keeping a close eye on Bank of Queensland's AGM on the 6th of December, Tim, especially, remember, following the recent abrupt departure of its CEO and how that can affect its strategy going forward.
And now to Under the Microscope, Kien, and we have to put this week Collins Foods right under the microscope because, like Objective, they came out with quite a significant announcement. The company, firstly, is one of the largest restaurant operators in Australia, fast food restaurant operators, we must emphasise there, with local portfolio of 260 KFC restaurants, 20 Taco Bell restaurants also. In addition, it also has 60 KFC restaurants in Europe and 70 franchise Sizzler stores. Remember the old Sizzlers in Australia? They still exist in Asia. Earnings in cheap fast food restaurants should be relatively defensive, you think, in most environments. After all, the world, for some reason, especially here in Australia, love KFC, and the US, of course. But why was the stock sold off significantly, Kien, over the last week on the back of its first half financials release?
Yeah, it was really all about its profit margins, Tim. High input costs like labor, we've seen power prices and even poultry, they've contributed to its net profit margin compression. That's moved from 5% now to about 4.4% over the half. In addition, management, they are uncertain about a margin recovery in financial year 24, hence the reason why earnings growth in financial year 23 is forecast to be down by about 10%, despite expectations for stronger revenue growth, Tim.
Yeah, it's tough with these low margin businesses, isn't it, Kien? And higher input costs are definitely a common active risk that many businesses are experiencing at the moment, especially when you have a look under Golden Rule 2 and 3, or especially Golden Rule 2, that really tight net profit margin. And there are, so Kien, are there any levers that management might be able to pull to let off some of these pressures?
Well, Tim, the company had originally pointed to price increases across its menu, as well as pushing customers towards those higher valued food items, you know, those with higher margins. However, there is only so much they can do before undermining the company's proposition. And the proposition is really to deliver a value-orientated offering to its customers, Tim.
Yeah, and with Europe going through economic crisis, Kien, does the EU represent a significant risk?
Yeah, looking at the contribution there, the European part of the business contributes about 18% of its group revenue, but only about 7% of its group earnings. So from a revenue perspective, the contribution is large, but due to the high cost impact on margins here, the European exposure from an earnings perspective is becoming less significant, Tim.
Yeah, and following the savage share price reaction, Kien, the stock is now trading at a steep discount to its consensus price target under Golden Rule 5. Does this represent an opportunity potentially for investors right now?
Yeah, looking at this stock, Tim, although the company appears to be trading at a large discount to valuation, remember that the consensus price target hasn't really been revised lower to account for this margin downgrade just yet, and we need to wait a couple of weeks. And despite the quality of the business model, unfortunately, we've had to remove the stock from coverage, Tim, because it has failed our net interest margin threshold of 5%. In addition, there are other active risks that may weigh on the stock, including the loss-making business, Taco Bell. You know, once perceived as a growth driver for Collins Foods, it's now had to put a pause on its store rollouts and written down the business by about 17 million.
Yeah, it's a pity, isn't it? And I think that's the thing that really triggered the steep decline, was just the market was pretty disappointed that the management couldn't execute as well as they were expecting on that Taco Bell strategy. So Collins Food remains a quality stock, as you've just mentioned. You know, they're just missing on that net profit margin figure. But we must, based on our quant model or quantitative model, err on the side of caution. It's just a pity that on the very odd occasion we remove star stocks after really steep share price declines. But it doesn't happen often, but it occasionally does. And with inflationary cost pressures lingering into next year, it is prudent to ensure you have exposure, and we also put in front of you companies that have sufficient margins to help cushion a potential slowdown in consumer spending as interest rates really start to take hold. And of note too, Kien, that trend-sensitive investors should consider staying on the sidelines and be out of the stock if they're utilising the ST30 TSR as 30% stop loss re-entry indicator, as it's currently in a bearish trend. And if you have a look at it through history, since Collins Foods came in as a star stock, it really has worked quite nicely. And a question of the week, Kien, and we mentioned before, I think, that you know, now's not the time of year to become complacent. We're sort of right in the middle of reporting seasons, aren't we? And we're leading into the Christmas period where we can all, and understandably so, start to focus on other things in life and enjoy time with family and friends, etc. And really, but our portfolios, the market doesn't close really at all. So while it remains open, we're going to stay quite vigilant and passionate about that ongoing management of our portfolios. So now that there's so many unhealthy businesses out there, how can our Stock Doctor members really make sure that they do stay vigilant during this time of year, Kien?
Yeah, Tim, you know, one of the great things about Stock Doctor, it's got so many different tools, and one of those tools is this portfolio optimizer. And you can find this once you open up your investment portfolio under the portfolio manager. You'll be able to select the portfolio optimizer, Tim, and you'll be taken to this screen which tries to define your investment profile. So whether your objective is growth or income or combination of both, then you'll be able to select your sensitivity to share price falls as well. So once you've done that within the portfolio optimizer, you can then view your portfolio weighting to each stock and whether the stock does align to your investment objective. And that's based on the color codes on the right-hand side as well. And to rebalance your portfolio, especially you want to rebalance it evenly, simply click on the weight evenly button here, and instructions on the number of shares to buy and sell, or the number of shares to buy and sell, can be found by clicking on the view orders button here, Tim, as well.
Yeah, and that's only really if you're using the rebalance strategy, and there's also the no rebalance strategy, and also ST30 and ST30 and ST Max strategies as well, Kien, for those that are trend sensitive. And they're all available now in our redesigned resource center, very easily to navigate to find our really important education videos. And Robbie, who's looking after today's recording, done a great job in redesigning that with the team. So it's all there, really easy to navigate and find those educational videos, the white paper and coaching videos, which will allow you to get the very most out of Stock Doctor and not fall into a state of complacency this time of year. There's also, Kien, the alerts. I really recommend that you set up your alerts this time of year relative to any star stocks that might be removed, announcements, earnings trend revisions, SD Max, SD30 TSR, if you're using them, if they get triggered, you'll be alerted straight away. Just create this really efficient way to manage a portfolio while you're hopefully enjoying some nicer things in life. Excuse me, but that's all we've got for another week, Kien. Until next week. And as always, thank you so much for joining us. Love your passion and the wonderful insights you share with our members.
Yeah, no, it's been a pleasure, Tim. And as the year closes to an end, it has been a challenging year for us, but we have, we're sticking to our key principles, Tim. It's about blocking out all that noise and investing in those quality stocks, because we know that those quality stocks will eventually recover and outperform the markets over the long term.
Yeah, absolutely, Kien. It is about, blocking out that noise, as you've said, riding through these cycles, having faith that the quality businesses will prevail, financially healthy, high quality businesses, growing, sustainable yield metrics are in place. And they'll prevail at the end of the day with that long-term focus. But we sound like a broken record sometimes, but we just love to reinforce those points that allow us to be resilient through all market conditions. But that's it for now. Have a happy, healthy, and prosperous week. See you later, everyone.